The formula that broke Wall Street. So Wall Street was in crisis from 2007 to 2008, as we all know. And Lehman Brothers collapsed because it overloaded itself with risky CDOs backed by subprime mortgages, used too much leverage, and was caught in a liquidity crunch when those assets defaulted. The collapse on September 15th, 2008 triggered a global panic and marked the most dramatic failure of the 2008 financial crisis. There was a couple of headlines that occurred during this time. AIG Lehman shock hits world markets. US to take over AIG and 85 billion bailout. Central banks inject cash as credit dries up. Mounting fears shake world markets as banking giants rush to raise capital. US drafts sweeping plan to fight crisis as turmoil worsens in credit markets. Goldman Morgan scrap Wall Street model, become banks in bid to ride out crisis. Bailout plan rejected, markets plunge, forcing new scramble to solve the crisis. So we're going to talk about several topics as a result of this financial crisis. We're first going to start with macroeconomic effects. Then we're going to talk about CDOs, the pool of assets that back the CDOs, CDO tranches, what the models assumed, the Gaussian copula. The Gaussian copula will be explained. Model breakdown to market meltdown, how that occurred, and then some of the lessons learned. So, what were the macroeconomic effects? In 2008, the collapse of the US housing market triggered a global financial crisis at the end of the turmoil were mortgage-backed securities. At the center of the turmoil were mortgage-backed securities and their exotic cousins called collateralized debt obligations, abbreviated as CDOs. These financial instruments bundled home loans into investment products and were sold as low risk due to complex mathematical models. The Gaussian copula was used to estimate defaults and assume that they would not occur simultaneously. When home prices fell and defaults rose, these assumptions collapsed. The results were US unemployment rose from 5 to 10%, over 8 million jobs were lost between 2007 and 2009, more than 4 million homes foreclosed, and global stock markets lost over $30 trillion. The US government passed a $700 billion bailout package, the Emergency Economic Stabilization Act of 2008, to stabilize the banking system and restore confidence. This included the Troubled Asset Relief Program, which aimed to purchase toxic assets and inject capital into major financial institutions. So CDOs were the engines behind the crisis. What exactly are they? A collateralized debt obligation is a structured finance product created by investment banks that pools debt instruments and transforms them into cash flow, generating securities. These securities are sold in tranches, each with a different level of risk and return. So what were the pool of assets in a CDO? In this particular case, it was mortgages, but in general, a CDO, the pool of assets could be mortgages, corporate loans, or bonds, and they serve as the underlying collateral. These assets generate cash flows that are distributed to investors based on the tranche structure. The performance and credit quality of the underlying assets directly determine the likelihood of repayment and the risk associated with each tranche. This was a critical flaw in the product MBS used to structure CDOs contained subprime mortgages. So what are the CDO tranches? CDO tranches are the layers into which a collateralized debt obligation is divided based on the levels of credit risk and payment priority. So the senior tranche is the safest. It receives payments first and offering the lowest returns. Mezzanine tranches carry moderate risk and are paid after the senior tranche. The equity tranche is the riskiest, absorbing the first losses, but offering the highest potential return. This structure allows investors to choose their level of exposure based on risk appetite. So here's how a CDO is constructed based on its tranches. First, you've got the pool of assets, right? Which we saw. And they're bundled up mortgage-backed securities. Second, we got the equity layer, which is the lowest rated one. Third, we've got the mezzanine, which is moderate. And then finally, we've got the senior tranche, which is AAA, which is basically the safest. And we saw that basically the credit rating agencies gave it AAA when it shouldn't have. Okay. So what did the models assume that made it so dangerous? It assumed low correlation of defaults. The models assumed that the individual mortgage defaults were mostly independent, especially across different regions or borrower types. This meant defaults would occur sporadically and not in clusters. Okay, so this is a graph of basically two types of loans, right? A and B, and we can see that they're basically, the model would assume that there is no dependent structure in it. The geographic diversification would protect investors. So if a group of houses or would default in California, that wouldn't influence what would happen in Iowa or whatnot, right? That was kind of the assumption. Okay. In the case of looking at this, you could see that it's pretty plausible. I mean, this argument and assumption, I would think would make some sense. If we look at like the Las Vegas housing market, basically we see these wild boom and bust patterns, right? As opposed to like Washington, D.C., where the federal government basically has a lot of employees and the region is very stable, right? The government employs people for a long time and whatnot, right? We could say that that's not the case now, but back then we could make that kind of assumption and it would make sense. But that wasn't the case, right? It assumed that mortgages came from different states or cities, regional downturns wouldn't happen all at once. But when the housing prices increased across the board, it did. It was basically a umbrella effect affecting all states. And that's why I thought the risk would be spread out, right? And like I said, it's pretty plausible. If the losses would occur, right, the losses would be contained in the lower tranches. That was another assumption. Equity tranches would absorb losses first. Mezzanine might take some damage. And then senior tranches were safe and unlikely to see any loss. Copula math gave a reliable joint probability. The Gaussian copula combined individual default probabilities into a joint probability using a multivariate normal distribution. It relied on thin-tailed assumptions using the normal distribution, meaning extreme events were thought to be very unlikely. And we could see kind of a univariate representation of distributions, right? And we could see that the t distribution here as an example has way fatter tails, right? So the fatter tails would account for more unlikely events, the probability of more unlikely events to occur, right? And we see that the normal distribution is very thin-tailed, and it doesn't account for these extreme situations. So now we're going to talk about the math behind the Gaussian copula. The Gaussian copula is a statistical function used to describe the dependence structure between multiple random variables, separating marginal distributions from their joint behavior. It gained widespread attention for its role in modeling these CDOs, right? Modeling default correlations in financial markets for pricing these CDOs. So what are the statistical foundations? First, we start with a marginal distribution. Each variable has its own distribution, right? So we could model, for example, Las Vegas as a t distribution, right? And then we could model Washington D.C. as a normal distribution. That's what I'm basically trying to say. Then we apply Sklar's theorem, which allows you to separate joint distribution in two parts. First, the marginals, how each distribution behaves marginally, and then we combine using the copula and see how the variables depend on each other, right? So we've got this fx1 to xd. We use that c to model each of those f1, x1, f2, x2, x2, xd, right? So we finally have c u1 to ud. u1 to ud is basically a uniform random variable, which goes from 0 to 1. Third, we define the Gaussian copula. We take each uniform random variable and then we map it to a standard normal using the inverse CDF. And then fourth, we assume joint normal dependence. Okay, so we map the standard normals, Z, right? And we use the multivariate standard normal distribution with correlation matrix to combine all of them. Now we're going to go on to an example. So practical example of joint default of two loans. So that's what we're going to be doing. So we're going to estimate the probability that both loan A and loan B default within 1 year, assuming each loan has a different default pattern, marginal distribution, right? And then second, we want to model how their defaults are correlated. So first step is calculating the marginal distributions from the historical data. We have an exponential with lambda is equal to 0.5. We have its CDF. We have a log normal with mu equals to 0.5 and a sigma of 0.3. We get its CDF. The second step is to convert the uniforms to the standard normal, and we saw that earlier in our equations explaining the Gaussian copula. And the final step is to use the bivariate normal density with a rho of 0.7. And if we calculate that, right, we combine the two uniforms, right? And then we get 0.031 probability of default. If you saw earlier, I might have gone too quickly, but individually, the probability of default is a lot higher, right? For uh, when they're separate, right? Individually than 0.031. So now I'm going to explain the model breakdown and how that affected the market. The model underestimated joint defaults due to normal assumptions. Okay, so that was one thing. The Gaussian copulas assumed default times were dependent on the multivariate normal. However, multivariate normal correlation doesn't capture tail dependence, the tendency of many defaults happening together during extreme events. The model implied, sure, defaults are correlated, but extreme joint defaults are very rare. In reality, during stress, defaults clustered, amplifying losses in senior tranches. Correlation spiked during stress. The model just didn't adapt. The copula used a fixed correlation matrix, right? So that rho was fixed and not dynamic. The model couldn't adjust dynamically. Okay, so when the correlation started going higher, the model just couldn't handle that. The entire tranche stack unraveled. Even AAA was not saved. Tranches were structured so that lower layers absorbed losses first. The AAA tranches were marketed as almost risk-free, only affected if massive defaults occurred. But because the model underestimated joint defaults, senior tranches got hit much sooner than expected. Investors who thought they were holding safe assets ended up holding junk. So what were the major lessons learned? I'm going to give you more statistical reasons, but I think it should be helpful for any type of modeling that you would want to do in the future. Correlations shift with markets. That's the first thing. Tail risk is not Gaussian, right? So there are extreme events that a Gaussian distribution cannot capture. We saw that earlier when I was comparing the normal distribution, the Gaussian, to the T distribution. And thirdly, models don't always capture reality, right? So I mean, going back to the normal distribution, not calibrating what's exactly happening correctly, and also having a fixed correlation number when it's not, when the correlations are actually moving up, right? The correlations of defaults. So that's my presentation. Thank you very much, and take care.